getting back to our learning objectives all across this term, we've learned the accounting treatment. We have learned how to amortize the carrying value over a certain period of time, because we are reporting it at a certain interval. So we need to amortize the carrying value of the intangibles. So we actually learned how to amortize the intangibles. We learned how to value goodwill. We learned how to conduct various tests to actually record impairments in intangible assets. And we also learned that in what's the difference between the accounting of internally generated intangibles and how are they valued once they are acquired, and once they are acquired, they become intangibles on the balance sheet of the acquirer. So this is something just to give you a overview, a bird's eye view of what we have tried to learn all across this course. Hi guys, I did a video for the other courses, a review video to review whatever we have learned till this first midterm. I thought, why not give it a try for financial accounting as well. This is just a small short video just to review whatever we have learned up till now. So we have been dealing with all our learning objectives so far have been revolving around the accounting of financial accounting and reporting and recording of transaction related to intangibles. Intangibles we have classified, we have learned that intangibles have been on various dimensions. First, the measurability, the accounting treatment of them, and the reporting of them. So how are they actually reported, and how are they actually accounted, and how are they actually measured? And most importantly, one thing that differentiates intangibles is the lifetime. There are limited lifetime intangibles, and there are unlimited lifetime intangibles such as goodwill, and limited such as copyright or a patent. So lifetime has its own importance in the amortization, which is also one of the key learning objective of this course so far. We know how to value the carrying value of an intangible is associated to it. Then it is amortized over its lifetime, say 5 years. Then we amortize it across a period of time, and then we amortize it, and we come up with a closing value of the carrying value at the end, year end, or year end balance sheet. So we know how measurability has been dealt in this course. We know that we associate, we do the due diligence, and the acquirer actually associate a value to all those intangibles, and eventually the difference between the market value and the difference between the market value value paid to the seller and the fair value works out to be the goodwill. Goodwill has been a kind of a plug-in value, and we arrive it after goodwill. Then we learned how to record impairment with the changing fair value of the assets over as the time passes. There might be a downward trend in the fair value of the assets, so we might end up recording impairments. We learned that intangibles can be internally generated and externally acquired, and we learned that for internally generated, all the R&D expenses are expensed over the period of time when they are incurred. But eventually the most important cost that actually go into the value of the intangible created is the legal cost, or the directly relatable cost with a certain level of reliability that is legal cost that is associated to the intangible created internally. For a certain period of time, we amortize it, we incur more costs to defend our infringements, or once they are successful, we report it in the carrying value. Once they are not, they are unsuccessful, we learn that they go to the expense account. So they go into expense. So the successful efforts are added to the intangible value. Unsuccessful go into expense. So we need to be very clear. The questions that we are going to deal with would be testing us on the accounting treatment, how we actually identify certain expense to be reported as a balance sheet item or an income statement item. Then next, we are expected to record them as journal entries, and then we are going to consolidate them at an snapshot time, maybe 31st December. So this is what our course or our lectures have been revolving around. So I know you guys don't like theoretical discussion, so let me move on to solve some problems to get you an idea of and to get a review done for the actual thing that we are expected to do in this course. So here you go with an actual problem. We have this actual problem. Let me enlarge it for you guys. You guys must have seen in our slides as well. We have discussed this in the class. Just for the sake of a review, I'm discussing it here as well. So the first thing that we see in this example is there is an acquirer, there is an acquiree. KP is acquirer and is acquiring it for 2,000. This value gives you what? The market value, which is being paid against what? The assets of the company. And to be more specific, the estimated fair value of the company, because estimated fair value may differ from the book value of the company. So here we have discussed that what's the difference between the value paid or the cash paid, which is the market value, and what's the difference between the estimated fair value and the book value. Such problems always give you the book value, fair value, and the market value, and it asks you to record this transaction, the acquisition transaction, and record the tangibles as well as intangibles, so so as to highlight what has happened during this acquisition and report it to the stakeholders. So yes, the best way to approach such problems is to make journal entries, because that would give you an idea that what has happened across the period of time and how are we going to report it and consolidate it at the year end. So in this acquisition, the most important thing that the tangibles have been defined for us, the fair value of the tangibles, even the property, plant, equipment is there. We are given with the liabilities as well. They are the same as the book value. Then we are also given with what the intangible assets that has been these values have been arrived by the acquirer or the buyer of the business. So 200,000 was assigned to customer list that they are acquiring, that they are going to acquire, and besides the proprietary technology that has been, for example, in the class we discussed that AT&T acquired AOL. So AOL might have these customer list and this internally generated proprietary technology that would have not been there on the balance sheet of AOL, but while the AT&T actually was buying it, they might have to value them as a part of the as a contra entry against their purchase. So they need to report it to their financial to their stakeholders that how actually they have valued the intangibles, but how they have actually valued the intangibles. So moving on, journal entries. Firstly, for the most clear thing that we know is that the cash has left us, right? We are reporting for the acquirer. So cash has left us. Cash is an asset. Uh, so we are going to credit it to report the decrease. So cash has decreased. So that's a credit entry. So I am going to the extreme right to report it, just to make sure that it's a credit entry. So it's how much? 2 million. So 2 million has been the cash outflow. Besides, we are acquiring the liabilities of the company. Liability, again, is increasing, and it's a credit transaction. We have discussed that. So 170,000 is the payables. Other liabilities are 30,000. So just for the sake of clarity, we know that that it's 2.2 million of the credit transaction altogether. We don't do it in the general entries, but just to give an idea. However, on the debit side, recording the debit side, these have been the liabilities, other liabilities. On the debit side, let me change the pen for this. On the debit side, what we have done is, of course, let's be very clear, we are going to report the fair values over here. So book values are just are just an indicative thing for us to know. So yes, what we have acquired is from the balance sheet, we acquired 2,000 cash. Account receivables have been 80,000, and what else? 78,000 was what? Inventory, stocks, and we had property, plant and equipment, which was 900,000. But what else we have acquired, and I have ended up writing it unclearly as usual. But however, what we have done, what we have actually, besides these balance sheet items, we are actually getting some more intangibles as well, as reported in the question. So the customer list is of 200,000 customer list, and there's one more thing, which is technology. I am writing it briefly, which is 500,000. Now, as a rule of thumb, everyone, as a basic accounting principle, the debit should be equal to credit. So what we do is 78,000 plus 2,000 is 80,000. 80,000 plus 80,000 is 160,000. Plus 900,000 is 1060, plus 200,000 1260, 1760. The eventual total sum of is 1.76 million. We already discussed this in the class. There is a differential. We can see easily that there happens to be the net of the credit entries and the debit entries are differing, and the differential is 440,000. This 440,000 has to be a debit entry because this is debit entry because the debit side is lesser than the credit side. So recording it, what we are trying to do is we are filling this gap of 440,000, and this gap filled is usually called a plug-in value called Goodwill, which is 440,000. This is going to be the journal entries of our intangibles. Now, just to give you an idea that how this problem can be progressed, or further questions may be asked. First question would be asked that what's the goodwill value associated to it. I might give you another, the this goodwill value can appreciate or incur impairment. Impairment must have been due to the changing or changes in the fair value. If the fair value over a certain period of time, for example, in 2012, the fair value was this, and it has decreased over a period of time, there must have been an impairment. Impairment can be due to overstatement or understatement of the other intangibles such as customer list or impairment. So we need to be very clear what impairment is. So one can test you on how to report impairment. Impairment is, of course, contra account on it's a loss on impairment, and the contra account is goodwill, because goodwill is impaired. So yes, this is it. Besides the other parts, which is not certainly a part over here, but the other things that can be tested on this is how these intangibles, limited life intangibles, are amortized, and what are their carrying values over a future period of time. How are they going to be amortized over a certain period of time? So this actually works out to be exactly similar to how we actually depreciate property, plant, and equipment. However, we will be doing a separate problem to look into this as well. I hope this is useful for you guys. Okay, so one of the key learning objectives that you should expect to be tested on is how the limited life intangibles, or for unlimited life intangibles for that matter, are being reported over the year end. So we all, in such kind of problems, we are always given up with, let me choose a pen, beginning value. Then there might be certain addition over the period of time. There might be certain additions to it. Then there might have been certain amortization to it. Of course, that they are living for a limited time period, so they have to be their value has to be cut down with a certain value over the period of time. For example, if an asset is 100,000, 5 years of life, so every year they have to go down by 20,000 to be amortized over 5 years, such that at the end of the 5 years, the intangible asset has a zero carrying value. This is plain vanilla thing. Additions are usually what we have discussed in the class. Additions are something that is measurable and directly relatable to the maintenance of that intangible asset that was reported to us as a beginning value. For example, that what we have discussed in the class is maybe a certain legal cost to defend the infringement, certain R&D or modification. We need to be very, this can be tricky. So we need to be very clear whether it is directly related to the life of the patent. We might end up acquiring a competitor's patent just to flourish or safeguard our existing patent. So this is also reported as an addition. After this, the net of value that we come across is the carrying value at the end of the period. So this is something that you should expect to be tested on. All right. So here we go with the problem. Let me enlarge this. I don't know. Okay. So here is the problem. This is from your book. The first thing to approach a question is to know what we are supposed to be doing in this question, and what's the data given to us. And just skimming through the question, you would get to know that what the question is trying to test you on. So this Nile Industries had one patent recorded on the books at January. So the first period, the beginning period is 1st January. This patent had actual book value of 288,000. The reported book value, the beginning book value, the beginning carrying value of the asset is 288,000, and the remaining useful lifetime of 8 years. So we are very clear about it that we are amortizing this asset, intangible asset, over 8 years of time. During 2012, Nyland incurred research and development cost of 96,000. Now the question is growing, expanding, and trying to test your knowledge. You need to be very clear that whether to add this to your intangible asset or drop it as an expense. Now I leave it on you guys. We have discussed this enough in the class that R&D is not capitalized, doesn't go to the balance sheet, or doesn't go to the value of the intangible. So we are clear on that. And brought a patent infringement suit against a competitor. Now there is something that should invite our attention. On December 1, 2012, Nyland received the good news that its patent was valid and that its competitor should use the process Nyland has patented. So they are now telling us that it's a success. And we know that the successful legal suit has to be going into the carrying value or the balance sheet. The company incurred 85,000 to this. So now they have associated a number as well. So now we are very clear that the carrying value has to have 288,000 and 85,000. At what amount should patent be reported on the December 31st, 2012 balance sheet, assuming monthly amortization of the patent? Now, this is going to be tricky. We have to be able to differentiate and understand that this amortization has to be monthly, because our period started on 1st Jan. We spent around 11 months. This timeline is also very helpful to visualize things. And on 1st December, we incurred a legal cost. Legal cost was how much? 85,000. The value of the intangible was 288,000 at this point in time, and this is something that has to be added. And we are supposed to report. We are supposed to report as an accountant. We are supposed to report our balance sheet to our stakeholders and the net position, consolidated position of this intangible at the year end. So this is what is expected out of it. We know here that this 288,000 has to be amortized for 12 months, right? And this asset has to be amortized for 1 month. But before we amortize, we need to know the lifetime of these assets. So we know that this asset has a useful lifetime, remaining lifetime of 8 years. 8 years is 8 into 12 is 96 months. Now the tricky part that I want you guys to learn, that whenever the carrying value has a certain addition, we need to know that life of that addition is the remaining lifetime of that asset that it is added to. So the most important thing that we need to know over here, that this legal cost, what's the useful lifetime of this legal cost? So at this period, start of the period, the life of this asset was 96 months. After 11 months, the new addition life should be how much? It should be 96, right, minus 11 months, because 11 months has passed, and this expense has been incurred on 1st December. So this asset should have a useful lifetime of 85 months. So we are very clear about the per month amortization of both these assets. This asset has 288,000 divided by 96 months. This is the per month amortization expense of this asset. Whereas the other asset that we are talking about, which is 85 months, which has a life of 85 months, the per month amortization would be 1000. This is simple for me to calculate. Whereas this 288,000, how much should it be? Can anyone will help me? 288 divided by 96. So it's 3,000. That was simple. Okay, it's 3,000. So we're very clear that 288,000 was the carrying value. Amortized for per month is per month amortization is 3,000. So at the year end, 31st December 2012, we know that this asset has been amortized for 12 months. So 12 months, and this asset has been amortized for how many months? This was incurred on 1st December. 31st December, it's a period of 1 month. So the total amortization expense incurred across the life, across the 1 year period, starting January 1, ending 31st December, should be 1 month. 1 month for this legal expense. We multiply it by 3,000. We multiply this by 1,000. This is 36,000. And this is how much? 1,000. So we're very clear now that what should be the year end carrying value. Can anyone help me with this? Beginning value would be how much? Beginning value would be 288,000. We are very clear about this. But the ending value would have an addition of 85,000 and a subtraction of what? 36,000 and 1,000. 36 plus 1,000 is 37,000. I hope I'm right with this. Okay, let me see the solution as well to just get it verified. Yeah, I'm right with this. So this works out to be 85 minus 37 and plus 288,000 is 336,000. So this is the carrying value that is to be reported at the end of 31st December 2012. Now I guess we have learned how to time the additional incurred cost. We have learned how to amortize them. We have learned how to actually find out the beginning value, how to find out the carrying value, what to add, what to subtract. We have learned how to timeline them. So I hope this is going to give you the basic intuition of such problems, and the numbers can change. The problem is going to dice you around with a lot of different changing situations. All you need to do is to have a very clear view of what has gone across the year. If you make good journal entries, it would also be very useful. Journal entries and these timelines. Journal entries, you know that amortization is expense, it has to be expensed out, you know how to credit them or debit them, you know the beginning value has to be the carrying value, how it is reported. So I'm not going into the journal entries here, but I'm pretty sure that this is going to be helpful for you, for all of you guys, I hope. So this is it from me. I hope you all do good in the earlies, and all the best. Good luck, guys. Bye.